Choosing a whole life insurance plan shouldn't feel harder than choosing a BTO flat. But for many Singaporeans, it does. Different coverage types, different multipliers, different bonus projections, and somehow every plan sounds good. The problem isn't that whole life insurance is bad. The problem is buying the wrong one and realizing it only years later. So in this video, I'm going to walk you through how to choose a whole life insurance plan properly using a simple framework that actually makes sense. By the end of this video, you'll know exactly what to look at, from coverage and premium terms to cash value, multipliers, riders, and how whole life insurance really fits into long-term planning. Hi, I'm Fer from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. Number 1, your current death and TI coverage. The first question isn't which whole life plan should I buy, it's what do I already have? Do you currently have death and terminal illness coverage? If yes, how much? And more importantly, is it enough? A policy bought when you were single might be completely inadequate once you have dependents, a mortgage, or aging parents relying on you. Insurance is not about owning policies, it's about having the right amount of protection at each life stage. Number 2, what coverage do you need? Whole life insurance is just one tool. The real question is whether you need comprehensive coverage in one plan or targeted coverage to fill specific gaps. If you already have basic death and TI covered, you might only need to enhance protection with specific riders or another term policy covering CI, ECI, or TPD. This would make it cheaper for you. But if you're starting from scratch, a more comprehensive structure might make sense. This decision shapes everything that follows, including cost. Number 3, adding riders. Now that you know what coverage you need, add the necessary riders. Common ones include CI and ECI, TPD, accidental death, hospitalization income, and waiver of premiums. CI and ECI riders are especially important because illnesses doesn't just create medical bills, it disrupts income. So when you're focused on recovering, you don't have to worry about not working and not getting an income to take care of yourself and your family. Also, I've been noticing this a lot, but please take note that most riders pay out an advancement of your death benefit. What this means is that if you have a death benefit of, say, $50,000 and a CI coverage of 50K, if you're diagnosed with a CI, your 50K CI coverage pays out from your death benefit, then your policy terminates. So if you need 50K in death coverage and 50K in CI, structure it as 100K death and 50K CI. That way, after CI pays out, you still have 50K in death cover. Same thing for ECI cover as well. Also, take note that more riders doesn't mean better coverage. Sometimes a standalone CI or ECI plan does the job more efficiently. Number 4, total and permanent disability definitions. TPD is about income loss while you're still alive. And the tricky part is TPD definitions vary across insurers. Some define TPD as the inability to work in any occupation. Others define it as an inability to work in your usual occupation. That difference matters. So if you're a surgeon who can no longer operate but can still teach, one definition pays, the other doesn't. Some policies also change TPD definitions as you age, shifting towards activities of daily living instead, which is why comparing policies purely on price is dangerous. Number 5, choose a relevant base and multiplier amount. A multiplier temporarily multiplies your sum assured. For example, a 100K base with a 3x multiplier becomes $300,000 in coverage for a fixed period. This is useful when liabilities are high, mortgages, kids, dependents. The key is matching the multiplier duration to your real financial obligations. So let's say if you have someone dependent on your income until you're 70, then choosing a multiplier that ends when you're 70 makes more sense than 65 or 75. Once the multiplier ends, your coverage drops back to $100,000 as a base because there's no need for coverage after that. This way, you don't unnecessarily pay for higher premiums for coverage you don't need. Also take note that the higher your base coverage, the higher your premiums. So if you need 300K in coverage right now, you can choose to get a 60K base with a 5x multiplier or a 75K base with a 4x multiplier. This will help reduce your premiums further. And yes, multiplier benefits multiplies your rider's base as well. Number 6 are premium payment term options. Premium payment terms shape your long-term cash flow. Limited pay options let you finish paying earlier, let's say 10, 15, or 25 years, while coverage continues for life. The guideline to follow is the shorter the premium payment term, the higher the premiums. Longer payment terms feel easier monthly but cost more overall. And payment frequency matters too. Annual payments are often cheaper than monthly ones, usually about 2%. Number 7 is the participating fund performance. Whole life plans combine protection with cash value growth, but not all returns are guaranteed. Non-guaranteed bonuses depend on the insurer's participating fund performance and expenses. Insurers use smoothing to keep bonuses stable, but projections are still projections. This is why benefits illustrations matter. They help you see best case, worst case, and realistic outcomes, and of course, compare insurers properly, not emotionally. I have a video on what insurer participating funds are. I'll link to it in the description below. It's an important one when choosing a whole life plan, so be sure to check it out. Number 8, accessing your whole life plan's cash value. You can access your cash value through features such as policy loans, partial withdrawals, annuity features in certain plans. Loan charges interest and reduces payouts if you don't pay it back. Withdrawals permanently reduce your benefits. You can also surrender your policy to give yourself a whole lump sum, but coverage ends and it may trigger surrender charges. Also take note that not all insurers let you access your cash value later on in life. There are insurers that require to surrender your policy to get access to the surrender value. To me, this doesn't make sense as you bought a whole life plan to get insurance coverage for your whole life. If you have to surrender it, then might as well purchase a term plan and invest the difference. That will give you lower premiums and possibly even higher returns over the long term. So please be very careful when choosing your whole life plan because this matters a lot and you might only realize it after it's too late. Number 9, affordability. Affordability doesn't mean the cheapest premiums. It means getting the right coverage first, then fitting it sustainably into your budget. Over-insuring strains cash flow. Under-insuring leaves you and your family exposed. So be sure to choose a policy that's within your budget so that you don't struggle to make premium payments. And do consider buying a term plan and investing the rest instead of a whole life plan. It's cheaper with potentially higher returns. Choosing a whole life insurance plan isn't about chasing the best brochure, it's about aligning the coverage, the cost, the flexibility, and long term goals. There are cases where a whole life plan makes sense, while in most cases, a term plan would make more sense. So be sure to match the policy type to your needs, not your agent's pockets. If you want help structuring this properly for your situation, we'll leave a link in the description to speak with one of our partnered financial advisors, no obligation. If this video helped, like, share, and subscribe for more clear, practical financial tips. Thanks for watching. I'll see you in the next video.